Good morning from cloudy Chicago. I'm John Kosar, Chief Market Strategist and Portfolio Manager at Asbury Research. Thanks for viewing our latest Following the Money podcast. Today's date is Sunday, July 13th, 2025. Before we get started, here's a little bit of information about us. Asbury Research is a registered investment advisor, or an RIA, and we have been providing both investment research and asset management to individuals and professional money managers since 2005, which makes this our 21st year in business. We have two levels of research service available. Number one, our Asbury Premium is for more serious investors. It includes the latest updates on all of our data-driven models and some personal instruction on how to use them. We also have our entry-level Substack newsletter. It's $25 a month. It's a very small subset of what we offer for the Asbury Premium service. It doesn't include any of our trading models. There's also a free Substack version of that service. So if you like our videos, you like our approach to markets, I strongly suggest that you at least sign up for the free version of the Substack newsletter. You can do that at asburyresearch.substack.com. We're going to show that webpage in just a little bit when we get there, because we're going to be taking a look at our sort report, which is part of the Substack service. We also offer managed accounts for both individual investors and for financial advisors and portfolio managers as a third-party manager. This year, through Friday, of the seven model portfolios that we offer, 6 of them are outperforming the S&P 500 year to date, all with significantly lower drawdowns, significantly lower volatility within the portfolios, and better risk-adjusted numbers, Sharpe ratios, things of that nature. Contact us via the contact tab right here at asburyresearch.com to request more information about these model portfolios. In today's podcast, our focus is on just how much higher the stock market can go this summer, with apparently tariffs are looming. They're supposed to start going into effect next week. They've been postponed. They've been ratcheted up and ratcheted down seemingly every other day. So the market really doesn't know what to do here. I think you can see that in some of the sector rotation, that generally speaking, the trend of the market is up, but there's a lot of indecision out there that with the wrong information coming out that has to do with tariffs, this thing can turn ugly very, very quickly, especially after we've gone so far just since the early part of April. So a lot to look at, so let's get started. Let's begin with our Asbury 6. And here's the Asbury 6 right here. This is through Friday, 7/11. You can see all 6 of our constituent metrics in the A6 are all green. Bigger picture, you can see we caught a couple of these tops here in the A6 on the middle of December of last year and February 21st. We went back into the market on April the 23rd. This is the green arrow here. We had just a quick move to negative in the A6 between June 17th and June 23rd, but we've effectively caught almost all of this move from April 23rd. And with all 6 of the constituents being green or positive, we don't know how much higher it's going to go. When 4 or more of these turn red, that's going to tell us that the internals of the market have weakened to the point where we're now going to start playing a little bit of defense and locking in some profits. The Asbury 6, for those of you that are familiar with it, it's a daily driven gauge of the U.S. stock market's real internal health, according to these 6 diverse metrics here that you can see on the graphic, which we selected and put together as kind of a team via quantitative backtesting. Every individual indicator has an Achilles heel. No indicator works all the time. That's probably one of the questions that I get asked the most is, what's your favorite indicator? I don't have one, because they all have their shortcomings. They all have their faults. They all have periods in the market where they don't work. So this is where the A6 has a really big advantage. Year to date, the A6 has outperformed the S&P 500 by about 2%, but with only half the drawdown. The S&P drew down about 19% from top to bottom. A6 is about half of that, with an 8% lower standard deviation and less than half the beta. This means that the A6's volatility has been significantly lower than the overall market, and it indicates more consistent returns with lower risk. The downside for some investors might be that the A6 is pretty active. Annualized, going back to 2017, there's about 11 round turns per year. But the upside is the A6 has outperformed the S&P 500 85% of the time during that period, which is about 7 years, or for 668 of the 1,942 trading days during that period. The A6 is part of our premium research service. Now let's take a look at sector rotation via our CEF model. So we're going to change views here. We're inside the research center right now. This is the paywall. And here is the CEF model. The CEF model is a completely data-driven sector rotation model. It was created to quantitatively identify long and overweight opportunities in U.S. market sectors by following the money as it moves around the 11 sector spiders, which I'm circling here, which if you put them all together, that's the S&P 500. It looks at them in multiple time frames. Trading, which is 1 week, tactical, which is a month, and strategic, which is a quarter. The CEF model is always fully invested in the market, providing investors with a dynamic alternative to the traditional buy and hold portion of your portfolio. According to hypothetical backtesting, since inception in June of 2018 through the present, the CEF model has significantly outperformed the S&P 500 on an annualized basis, with a significantly lower standard deviation, a lower beta, and significantly lower maximum drawdown. Better performance and less risk. That's what we strive to do here. The XLK, the important thing to note here in the change, since April the 28th, let me back up a step. The way that the model works is we're always invested in the top 3 sectors according to the CEF model, and those are the ones with the lowest scores up top. So technology had been the top sector in CEF, 8 of the 9 or 9 of the 10 past weeks. Note that it drops to number 3 this week. It's still in the top 3, which means it's still being invested according to how we use the model. We always equally invest in the top 3. The model is updated once a week on the weekend, and any changes are reflected in what we do on the opening the following week. So rebalance on the weekend, and any changes to the portfolio, there's a new one. There's a new top 3, or one of them moves out, another one moves in. All that is executed on the opening the following Monday. But again, back to technology. 10 of the 11 weeks, it's been number 1. It's dropped to number 3, which still means it's one of the 3 that we're investing in, but we have the utility sector up top. That suggests to me internally there's a little bit of defense going on. Maybe it's in front of these tariffs that are supposed to take place next week or start to take place next week, or some of the changing of some of the tariff information coming out of the White House. I don't know what that is. We don't need to know that. All we need to know is that our number 1 racehorse here, technology, is dropped in the pack, and defensive utilities is now number 1. Let's just, for a second here, I'm going to change views, and we're going to take a look at XLK. So here's XLK. It initially moved into the top 3 according to the CEF model right here on April the 28th. That's the orange arrows that you're looking at here. So since then, it has outperformed it has risen outright by 24%. You can see it right there on the left of your screen. while outperforming the S&P 500. This is relative performance here, XLK versus SPY, while outperforming by 9%. The A6 and the CEF model, let's get back to the CEF model here for a minute. The A6, Asbury 6, and the CEF model are both a part of Asbury Research's premium research service. Contact us again here via the contact tab at asburyresearch.com to request information about service, details, and pricing. Now let's take an updated look at our SORT report, which is a part of our entry-level Substack online newsletter called Asbury Research Chart Focus. And here we are, right here, Asbury Research Chart Focus. This is asburyresearch.substack.com. This is where you could sign up for the free version of this. Our SORT report tells us which parts of the global market have positive trends, are outperforming their benchmarks, and have positive asset flows, which means that new money is propelling their prices higher. This is a very low-cost way to make better investment choices based on data and not opinion or forecasting or what we think is going to happen with interest rates or tariffs. All we're doing here is following the money. The way this works, let's click in here. At the heart of SORT is a distilling methodology for identifying market opportunities summarized into 3 core pillars of what we look at here at Asbury Research. We look at trend, we look at relative performance, and we look at money flows. We have our proprietary way of looking at these. But right now, we've got U.S. small cap, or IWM. We've got a green cell in trend, relative performance, and also money flows. Let's make that a little bit bigger. Also crypto, GBTC is the ticker that we use for crypto, green all the way across. And we have U.S. technology, which we use the Qs. So these are the 3 based on a pretty broad, this is kind of like a broad sorting machine. We're looking at emerging markets here, global equities, X the U.S., commodities, gold, interest rates, crude oil, dollar, covering a lot of territory here quantitatively to tell us what is working. What's not working is U.S. interest rates, crude oil, and the dollar here down at the bottom. But let's look at these. Let's go back to our chart and first look at IWM. And let's see how what we're seeing by the SORT report, how it equates to what we're seeing on the chart. So here's IWM. This orange line that I'm tracing with my mouse here is the 200-day moving average. So we're back up above the 200-day moving average here in IWM for the first time since, what do we got here, back in February. Underneath, we've got the relative performance of IWM versus SPY. Note, as I get a little bit closer, it's starting to outperform. It's up above its 63-day moving average, which is the yellow line here. So looks like an emerging new trend relative to the 200-day moving average, and we're starting to outperform the S&P 500. I've heard people talking about small cap all year. Since December the 12th of last year, up until a little while ago, it underperformed the S&P by 11%. Why would you want to be in small cap when it's underperforming the S&P? All you need for the S&P, all you need is an account and buy SPY and cross your fingers and hope the market keeps going higher. So this is telling us now, after a long time of people chatting this up, it's starting to work. Let's go back, and then we're going to look at crypto, which is GBTC. And again, these are our own internal charts, so they're a little messy. There's a lot of lines on them, but it kind of gives you an idea of what we do here all day. Look at a lot of charts, look at a lot of data. GBTC, Grayscale Bitcoin Trust, is making new all-time highs right here as of the latter part of last year. And also look what it's doing. It's starting to break its old extreme, relative outperformance extreme versus SPY. down here. So Bitcoin looks like it's starting to make a new leg higher. And how did we know? Because the short report told us this is where to look for opportunity. The third one is Qs, QQQ. So we'll go there now. And the Qs making new all-time highs right here as of about 2 weeks ago. And it's testing its previous all-time relative high versus the S&P 500 right here. So this tool, again, for $25 a month, if you're not somebody that wants to get into our models and some of the performance of our models and the risk reward there and wants to keep it simple, this is a great tool. I believe you get this twice a week if you sign up for the Substack for $25 a month, or I think it's $250 a year. You go there and there'll be a link there so you can check that out. But a really quick and easy way to see, okay, where's opportunity? Now from here I can go into some individual small cap stocks if I want to. I could look at some of the big cap technology names that would be in QQQ, but this basically tells you where to look for value. So just finally, if I could take another 2 minutes, a couple of quick announcements. This Wednesday, July the 16th, I'll be on the Schwab Network at approximately 9:15 in the morning Chicago time for my regularly scheduled monthly interview there. I've been doing this for several years. I'll be going over the latest update on the A6, on the Asbury 6, and this will come right after the June PPI or CPI and PPI inflation-related data that's going to be released in the morning prior to the opening on Tuesday and Wednesday morning of next week. Also, on Wednesday, July the 23rd, I've got a slide for this. On Wednesday, July the 23rd, I will be presenting Asbury Research's semi-annual educational webinar for Fidelity Investments. This is my 11th year of putting on these presentations for Fidelity this year. And this is actually the link where you can sign up. And this year, my son Jack and I will be spending about an hour talking about all of our models, what we see in the markets, and what we're expecting for the rest of the year. Again, you can sign up for the webinar at fidelity.com right here, or you can contact us at asburyresearch.com and use the contact tab up here, and we'll send you the link to sign up in case you can't see it on the video. So there you go. That wraps up our latest Asbury Research's Following the Money podcast. Our next Following the Money is tentatively scheduled 2 weeks from today on Sunday, July the 27th. For questions or more info on any of the research models and model portfolios we talked about today, you can contact us via the contact tab at asburyresearch.com. And please don't forget to like and subscribe. Have a great Sunday. I'll see you in 2 weeks.